Hey everybody, Preston Bryn here with our Trader User Group free weekly roundup for the trading week ending D16, 2016. Now, as we go through the end of this year, it's been a really interesting finish. Most of the market gains this year have been through the end of the year. And as we had said, as I had said in Q4 of 2015, I said 2016 would be the year of the currency, which then basically implies year of debt and debt opportunities, and that's what we've seen. Now, what I've got on the screen here is a weekly chart of the E-mini S&P 500 futures, which is what we follow a lot every day, in fact. And we use this as a gauge or a windsock, if you will, into where the markets are moving, where money wants to go, and just how far and how fast we want to get there. Now, this chart, this weekly chart, goes all the way back to 1997, so it goes back quite a good bit. Okay, so it's about 20 years, about 2 decades. I wanted to show you guys a couple of key things that we're looking at now as we go into 2017, because 2017 promises, if you can believe it, to be an even more exciting year than 2016. And we're going to have some great profit opportunities as we did in 2015. And I'll make a little announcement here with you guys towards the end of this video here. But looking at the chart here, if I were to set in place here just a couple of key lines, let me just put a few things in here. You can see here that as I draw in a couple of these key areas on this weekly chart, okay, you can see here on this weekly chart as I put it in, and let me just see that this thing seated itself properly here. Yeah, so we've got here the all-time highs of the E-minis, 2273. And then over a longer period of time, I've identified these key areas here, these key support and or resistance areas. And we'll plug in these here like this so that we can get them in here pretty close. So these are pretty close to where we're sitting here. Now, going back in time like this, and it's always helpful at the end of the year, we always do this to kind of give us a gauge or a windsock, as I said, for what we may be doing in 2017. But you can see here, this was the dot-com bubble right in this area here, and this was the right before the implosion in 2007. And you can see here that the pullback or the draw to the downside has been quite extensive during those times. If we look at this and we look at the pullback here, you can see that during the dot-com bubble, we pull back, and this, I'm not getting it exact here, but it should be close enough, around 50%, 51%. And then you can see during the 2007 catastrophe right here, and let's just get it here so you can see on the screen, we pull back 57%. Huge, massive pullbacks. Now, this is the index, guys. This isn't a stock. And then March 9, 2009, we just exploded higher, and then we've had a few downward drafts, but generally the markets have just been on an explosive tear since the lows that were made on March 9th, 2009. And then we've just exploded higher, as you can see here. But now I think 2017 is going to be in for some surprises. And where do I say surprises? We have a lot of potential existential threats to the market. Now, I always say trade the price action. Forget what they're saying on TV, because the price action will tell you what you need to do. And that's been so true. I know a lot of my friends have just been aggressively bearish this market, leading back to the, in fact, they were bearish going into the Trump election or the Trump win presidential election, and they're still bearish going out of it, and they're getting decimated right now. And yeah, there are ways to hedge it by selling premiums in the option market and everything, but they're fighting this thing. Meanwhile, we've been making really good money in the markets because price action just says, hey, we want to go higher. Trump is going to throw out there a lot of inflationary tendencies. It's going to drive U.S. debt lower, interest rates higher, or debt higher, interest rates higher, bonds lower, that kind of scenario, U.S. dollar through the roof. So, but everything does come to an end. But when I say end, it does not necessarily mean that we're going to go into a bear market. Although I have been calling, I said about 3 or 4 or 5 months ago, if you guys are listening in on these weekly roundups, you heard me say that I believe we're in for a 25 to a 40% pullback. The definition of a bear market, as you guys know, is a 20% pullback. A correction is 10% pullback. A softening, profit taking is, anywhere from 2 to 5%. And anything beyond that, it's, you start seeing more selling until maybe buyers step in around the 10% or so. That's a correction, but it's not a shift in sentiment. Now, I believe sometime in 2017 going into 2018, we're going to start a longer term correction in the market. I don't know what's going to be the driving force that moves it, and I don't pretend to know, and if anybody tells you they know, they're crazy. There are a number of things that can upset the apple cart. You've got China out there who is having a hell of a time with their yuan. Capital flight is leaving China primarily, and I was having this exchange this morning with one of our members, primarily due to the Chinese made a big mistake a decade or so ago when they pegged their currency to the US dollar, which at that time was great because the US dollar was in the toilet. So it was great for the Chinese to do that. But now with the dollar getting so much stronger, the Chinese are having to sell US treasuries to prop up the yuan. They sell the dollar and buy the yuan, and that's causing a lot of capital flight in the Chinese markets. And I think there was a report that just came out that said Japan is now surpassing China as far as the largest holder of US debt. So it's going to be really interesting, and keep in mind that the last big unknown existential event that caused the markets to just really fall off the table was the devaluation of the yuan that the Chinese did on August 21st, 2015. And it caused a big meltdown in the markets until China came out and said, sorry, we didn't mean to do that. And it happened right at this point here, okay? But what I'm seeing right now is, and the reason why I put these key price levels on the screen, is I just want to point out to you, as we go through the end of this year and we start to tee up 2017, and let me just come in here and let's put some extensions on the screen here. Let me find some extensions here. Let me just see, where did I put them here? Here we go, right over here. If we do these extensions and then I measure pivot points and what I want to do is I'm going to measure the prior major pivot point there and there, right? Because we're up into dry powder area up here, because you can see I have volume over price, and you can see here the area where most of the trading occurred, right in this level right here and right in this level here if I would extend over, which is why we've got, this is going to act like a magnet. And I'll tell you that in a bit as we get through Q1, get through the presidential inauguration. But if we look at this, let me just go back to where I was before. And let's pick this up here and let's come in here. Let me see if I can get this set here on this right here. And I'm going to move it out like this, right about like this. So what I did was I did a Fibonacci extension, okay? And that extension was done on 2 prior major key pivots. Okay, I think everybody would agree the high in 2007 and the low in 2009 were the key pivots. And notice it was a double top here, and then we gave it all back up, and then we finally blew through it in the Q1, Q2 of 2013. Okay, we finally took out this area here, and we started in March 2009, and it took us 4 years right here to come back up to where we started in 2007 with that move down. And 4 years later, we did the requisite, let's punch through it, let's do a retest, and then we're off to the races. Okay. Now, what I did was I took this pivot and this pivot here, and I plotted an extension here using fib. Now, if we blow this up, and let me just blow this up for you guys so you can see it here, so it makes some sense for you. You can see right here where in this area right here, the 2154 area, that's why I believe this is going to be acting like a magnet, pulling us back down. You can see it's near former all-time highs here at 2134. And our members laughed because we sat here and we challenged this area almost every week for about 3 or 4 months, the 2134. And then we finally peeled away, right? And we moved up and we made new all-time highs right in that area there, 2190, before we gave it all back up. And then we went from 2190 all the way down to 2027 area right here. And we were lock limit down on the election, 2028.50, and then it just exploded to the upside. Now, for those of you that are members in our group, or for those of you that are non-members, you missed a fun night because we were in the markets trading at 1 or 2 in the morning, and we put some contingent buy orders in on the Dow at 17,750, and that's when the Dow was at 17,550. And I told my members, go long the Dow at 17,750. And now, needless to say, I said, if that triggers, it's going to show a change in sentiment. And that's what it did. And the markets just exploded, especially the Dow. Now we're just kissing the 20,000 level. So at $5 a point, that turned out to be a great trade. But that's neither here nor there. I'm going to put, if you look at this, I do believe that right now the markets are still wanting to climb higher. The momentum's taking us higher. We just finished triple witching this past Friday, which the markets tend to want to go higher. Volatility tends to want to go lower. Triple witching is when you've got the quarterlies expiring, you've got the futures, the index options, you've got the monthlies, the weeklies. Everything is expiring and rolling out to January or March, depending on what the security or asset is. But now you can see we're sitting at this level right here, just slightly off our all-time highs. But I put this Fibonacci extension in here to show you guys that the 2154, 2134 area is going to be a really key area for us that we're going to want to watch right in that area there. I do believe that we're going to come back and we're going to retest this area. The momentum may carry us through the end of the year, but I think we're going to see this area again. It's just one of those things that we're going to see. The other thing that I want to show you now that we've made this extension here, and again, I'm staying on the weekly chart. Okay, now that we've made this extension off the lows, I'm going to do another Fibonacci on top of it right here. And I'm just going to do a Fibonacci retracement, and it'll be close. Let me just do it the other way here. Let's get I got the wrong one. Let's go like this right here. Where are we? I got it. It would help if I got the right one, wouldn't it? Okay, just like this. Okay, so now I've got the Fibonacci retracements on here, you know, and what we're really looking for here is, and let's just get this out of the way over on the left-hand side. You can see here all of the various touch points that are going to act as support on the way down. These yellow dashed lines are key price levels. The shaded zone is where I believe we're going to go. But the key I want you to focus on, let me just blow it up even more. The 50% fib level. The 50% is probably one of the most popular touch points in the markets. It is the one, or in the fib, when you extend, when you retrace. The 50% level is a really common one. And notice that 50% level is sitting almost near our 0.168 or 1.61% extension off the prior pivot highs and lows, going back to 2007 and March of 2009. So, and that is right in the top part of my support zone. So I do believe this is probably where we're going to end up somewhere in Q1. Okay, it's just one of those things that is probably going to happen. Notice here that you know, from this high here to the high up here, we do not have a divergence. Here, we do not have a cross in the MACDs. But should we get some softening, it's going to roll that top line over, and then we'll get that trigger, which is the trigger line in the MACD. It would set us up for a bearish divergence, which says we're going to have some softening in price, and we're probably going to test these areas. And you're going to see all the press. Should this occur, okay, now this is not what's going to happen. This is what the charts are saying, or the higher probability is going to happen. Should this occur, you're going to, I can see the headline news now. Trump gets trumped. Market trumps Trump. Pullback. Too good to be true. Trump bounce goes boing, or something crazy like that. They'll blame it all on Trump. Trump has nothing to do with this, right? This is just market reaction, fear and greed, extension, retracement, contraction. That's all it is, okay? But the press is going to have a field day with it. For us in our group, we're going to enjoy it because this is kind of what we're going to see. Now, let me just take this off the screen here. Let me just start deleting some of my lines here so I can also clean it up for you guys a little bit here. Let me just get all of this off the screen, and I'll go back to my original lines that I had on the screen here. So these were the weeklies. As I showed you here, the key major areas that we're going to come back and visit. Now, as a member of our group, we go through this every week and we look at it, and we're usually very good week to week on where the markets are going to go and where the key support, key resistance points are, right? So you can see these major pullbacks here, 51%, 57%. One thing I will do, and I'm not forecasting this right now, but I do want to show you here, that's 1574. I do believe we're gonna revisit 1574, believe it or not. And that was what I was saying is a high likelihood. And what the charts are saying, that would be a normal market, right? We haven't had a bear market in a while, and that would be normal. This 1574, as you can see, are the peaks back in the 2000 dot-com bubble in 2007. So now let me just, what I'm going to do is show you here. I'm going to put it back. I'm just I know your eyes are probably getting a little bit dizzy here with all this movement, but let me just move it right here, and I'm going to put the peak back up here again. I will do one other thing on the chart here. So we got the all-time highs here in the market at 2273 on the S&P 500. And then if we're going to measure this, right, what would that look like? Well, first of all, assuming that is the high, right, then a bear market starts to take place around 1818. Call it 1800, which is a nice round number, right? So if we look at this area right here, right, and I'm just showing you the symmetry of the markets. This is just market symmetry, guys. That's all it is. And as a herd, people invest as a herd, and you get the fear and the greed, which is all this stuff is. And now if we come down and we come right down to that level there, it's right at about 1806, but you can see it's roughly about a 20%. So if we hit this bottom here, this would be official bear market territory, right? Hitting the bottoms that we made in February of this year, 20% pullback. February the 11th, in fact. In fact, this was an area where I was signaling everybody based on what the charts were telling us to let's go long, right? Let's go long big time. And that's what happened. But now it gives us about a bear market territory right in that area there. But most bear markets do not stop at 20%. I believe it's going to carry us down around this 1574 area. And if we look at that and see what does that really mean chart-wise or percentage-wise, right at about 30%. Okay. Now I said the market would pull back 25 to 40%, but just coming back to the 2007 peak puts us at about 30% to me, which is a believable number in a pullback. Now, when would we get there? How would we get there? What would be the existential threat that drives us there? Who the hell knows? I don't know. You don't know. Again, if anybody tells you they know, they're crazy. But what we do know, the known knowns as opposed to the unknown unknowns, as Rumsfeld used to say, the known knowns would be we've got China and debt issues going on in China, right? We've got, as I pointed out earlier in this session, we've got a lot of things coming up in Europe next year. The euro is projected, I think Morgan Stanley put out a piece this weekend that projected the euro to go below parity to the US dollar in the coming 6 months. We've got key elections all across Europe next year, and if the populism wins like it did in Great Britain for the Brexit and in the US, that means the European Union could be torn apart with populism. If anything, at a minimum, the populists are going to gain more votes, right? So there is the chance of that starting to happen, and once that happens, then you're going to see some of the banks over there start to get in trouble, because a lot of them really are not in a very good health right now, which is why Mario Draghi is extending their bond purchasing program all across Europe. Japan is got their aggressive stimulus program going on. China, well, China does what China does, or as Trump says, China. China. But what we've got going on is a lot of potential existential threats. Okay, so keep in mind that I don't know what's going to happen, but we've got a number of events that could drive us into a bear market. We haven't had one in a long time, and it is due. Now, I'm not one of these believers that says, hey, just because we haven't had a bear market in a while, we're due, so we're going to get one. I'm not one of those. But I'll tell you what the herd is, which is the investing herd. Once we start going down, it becomes a self-fulfilling prophecy, and then you start to see all the business rags, the Wall Street Journal, Barron's, and all these others start putting headline, leading front page, top of story kind of events like, is the Trump magic gone? I guarantee that's what it's going to say, and all this other stuff. And I don't trade the markets politically, but based on who's winning and what's going on, we trade basically the herd mentality. And we follow the herd, and we generally do very well. So I can see this coming up. So there's a lot of opportunities here that's going to be presenting themselves in the U.S. markets in 2017. So this is kind of what I just wanted to just lead this weekly roundup off with you guys, because it's going to be very important. Now, I will give you a little hint, because I told our members this, and I haven't heard anybody say it in the financial press, which is amazing. But you're going to hear it here first, and then watch. You're going to hear other people pick up this my announcement this weekend on this thing, and then you're going to see all of a sudden, because I know a lot of people follow me, even a lot of other gurus follow me, because we're usually pretty close to what we're doing here in the markets. And it's funny how I'll say some things, and then all of a sudden you'll see it picked up by other things, but you're going to hear it here first. What is that? Well, let me tell you, and this is just a headline thing here. It's not something that I'm going to forecast is going to happen, but I will tell you that if it does happen, it's going to upset the markets, and it's going to happen this Monday. Okay, December 19th. What's happening this Monday, December 19th? I think some of you know, but a lot of you don't know. If you've got money in the markets, and if you're long, let me tell you what I'm going to have our members do. We're going to go out and pick up the Wednesday SPX out of the money puts, and you can pick them up cheap right now. Volatility is cheap. What's going on this Monday, August 19th? The electors vote to confirm Donald Trump as president. Now, you will see everybody say, hey, this is a black swan event if they don't vote to confirm him, but not here. You've heard it here first. If for some reason something really wild, and I like to call things batshit crazy when it gets like that. So let's say they don't vote him in, right? Let's say he doesn't get the 270 electoral votes. Let's say that there's enough electors that have changed their mind. I think the probability that happen is maybe 3 or 4%. But it's a very cheap insurance call for those of you that are going into the end of the year long. We're going out of the money and purchasing SPX puts cheap, because let's say, let me throw the event out at you. Let's say enough turn and don't vote him in, and he goes below 270. The masses will go crazy. The financial markets will go crazy, because what has happened is this move here from here up to here. Well, let me get it back again. Darn it. This move here from here up to here has been primarily on the concept and the idea that Trump is going to do what he says he's going to do. Let's say the markets all of a sudden throw into doubt and Trump may have an issue with the electoral votes. I'll tell you one thing. The first thing that's going to happen is the odds of a lock limit down will be very high. You can see this 3-ad extension there, which is off that key support area there. And if I were to extend it over, it's kind of in this area there. That'll be the first stop. All right. Now, keep in mind that we're right now at 22.55. All right, 5% of that number is right there. 5% of that number is 112 points. So lock limit down happens if we go beyond 112 points. And folks, we can do that in a nanosecond. And 112 points from the 22.55 takes us down to 21.42. The 50% level, and the point of this is that would be given up almost, that gives up about 50% of the gains. Why? Because the markets now throw into doubt the concept, or is Trump going to have trouble? Because if he doesn't hit the 270 electoral votes, it gets thrown over to Congress. Now, Congress has already said that they will vote Trump in, but that doesn't matter. It just throws into doubt the congressional vote. And guess what happens over the next week as Congress scrambles to get back in there, because they're going on holiday break, which will make it worse. They're going to have a special session, and then they're going to vote to say who wins. Now, they've already said Trump will win, but that would be enough of a dislocation to draw us into a lock limit down. We're down in this area here, and for those of you that just thought you'd take the rest of the 2 weeks off, you're going to be underwater a lot of stuff. Okay, now what are the odds of that happening? I'm calling it at about 3%. But if it does happen and you're long, especially if you got credit spreads, you're going to get killed. Okay, you will get killed. It would be an existential event. And we will give up at least 50% of the gains, because now it throws into doubt. And then if Trump gets elected by Congress, it gives everybody a chance to go back in long again. But if he doesn't, we're going to come back down, because it throws into doubt as to who's going to run this ship. So, guys, you heard it here first. Go out of the money, go to the Wednesday expiry, and just pick up some puts. That's what I've got our members. We're going to be doing it Monday morning. And let's say, and I saw some out of the money puts around $2, right? Way out of the money. And let's say that you buy 3 of them. All right, that's $600, and they expire on Wednesday. And even though we're doing it really tight because it's a one-day event, let's say that, you know, they vote him in, he gets the 270, which is what you would think. By Tuesday, you'll know it by end of day on Monday or on Tuesday, because the reports will be putting it out. Then those puts will probably go down to $1. All right, maybe 75 cents. So your net cost is going to be the $2 that you paid for it, less the value when you go to sell it. So let's say, all right, so you're going to lose, let's say $1.25. All right, so that works out to $125 per contract. Now I said 3, but it depends on how long you are and how much credit spreads you got out there. So you're looking at about a $400 insurance policy that says, I'm just going to guard against this existential threat. So this is for all of you out there that are ending the year, and this would, trust me, if that happens right here, this is going to go in the money, and that $2 is probably going to go, it's going to be worth $20 or probably even more, $2,000 a contract, right? So, you know, you're going to spend, you know, maybe $600 to make $8,000. It's one of these really crazy things. Now, there's other more sophisticated ways to play this, but I'm just making a really easy one here. Okay, the charts don't show it, the volatility doesn't show it. You can see here there's a bullish divergence from this high to this high here. That would suggest any pullback's going to be light and sweet going into the end of the year. So I just want to let you guys be aware of this. All right, so anyway, that's one thing that you heard it here first. I hope you heed my advice on this thing, because and if, let's say, you're not in the markets, then that would be just a risk to take. You know, do you want to bet, you know, $200 or $300 to make, you know, $10,000, $3,000, $4,000, $5,000 per contract on something like that? So that's kind of where we're sitting right now on the E-mini S&P 500 futures, all right? Now, these are all my indicators on the screen here. Let's go back over. I want to show you something else. Let's go look at the Dow Futures here. The Dow Futures have been on a tear. You can see the 2016 low price at 15,365. With the high price was made on this daily chart just a few days ago at 19,911. You can see the Fibonacci extensions here, and I've got them programmed here. But the key I want to take away from this one right here is just this. You know, if I take everything off the screen here, we're at near all-time highs, right? Let me put it back on. We're at near all-time highs. Look at the Dow transports as measured by the tracking ETF IYT. We're at near all-time highs here too. This line at 167 took out the prior all-time highs that were made back in 2014, okay, before we started this huge move down here, okay? Remember, the Dow Transports tends to lead the markets. The Dow Transports here led the Dow down, and the Dow Transports was 6 months ahead of the game, right? And by the time the Dow Transports were down here, then the Dow and the other indexes gave it up. Okay, so we made all-time highs here too. So when you get an all-time high in the Dow Transports, you get an all-time high in the Dow Futures. That is the Dow theory in action, which says that this bull market is for real, and we've still not really done just yet. Okay, but softening in price, yes, I do believe we're going to see some softening in price going into Q1. That's what I'm seeing here, bar any existential event. That's kind of how I see this thing shaping up. Now, one thing I wanted to talk about, the tracking stock for China, ASHR, that shows a completely different story. If I blow this up here, if you look at China, you can see the opening price here at 25.67. We're underwater in China for the year as we go into the finish of the year, and it has gotten ugly. It got ugly from December on. It has been very ugly in China. They're having trouble, guys. That is, and remember, the markets now are no longer trading independent of other countries. It is a global market. Buddies of mine that run big hedge funds, I'm in a fund that I'm responsible for in Europe, as well as here in the U.S. You've got, this is one of those things here that China can just drag everybody else down. It puts a lot of drag on it. Airplane speak, pilot speak. Eventually the drag is going to drop the energy and reduce the energy of the movement on the upside of other markets. But you can see we're coming down here. We just broke a key level that was a low made in September. And now we're coming down to the lows here that were made back in the summer of this year. We got to keep an eye on this, right? It's not an issue going into the end of the year, but we must keep an eye on it. Volatility-wise, okay, if we look at volatility, the VIX finished Friday, which at 1220. Remember, it's triple witching, so it's normal to see volatility come in, and it's the end of the year. So we've got this here like this, even given the dot plot by the FOMC this past week, where it surprised the markets just a little bit. They were expecting 2 rate hikes next year, but Yellen came out and said that they could be more aggressive. They always data dependent, but the dot plot indicated 3. But we're in the green zone as far as option strategies based on where volatility is right now. You can see the zones that I've got here for your members. Our members, you know what I'm talking about. For non-members, it's generally based on what zone you're in, is what's the most favorable option strategy that you want to deploy. All right, but you can see here we're coming down to 2016 lows in the VIX, which were at 1099. Okay, so the volume of the trading is going to really start to drop off now. Once we get through Christmas and then into New Year's, going into these areas, it's going to drop off dramatically. We've got our Trump bull stocks that we've been following. We've jumped into some of these. We're doing really well as we're going into the end of the year. If we look at treasuries, we're trading higher interest rates. You can see here bonds have just, they're ugly. just very ugly. This shows that inflation is coming. The yield curve, the difference between the 10-year and the 2-year, is up dramatically. Bonds is down, and of course, for our members, we're trading TBT to the upside. We've also, and it's just been a trade that you could see coming, right? And I think there's still more room here to run on that. Now, on the currency side, look at the dollar, guys. This is one of these situations that we haven't seen in almost a couple of decades. What is that situation? Well, with rising interest rates in the US dollar, coupled with massive stimulus in Japan and China, the way they hide it, and then all across Europe, the dollar is the only pig in the poke that's got lipstick, and that's what's really driving this thing higher. If I put it on a weekly chart here and just show you where we're coming from, right? Look at this. Can the dollar go higher? Yes. Now, I've got a near-term target of the dollar of 106, but you can see where the dollar is right now. We haven't been that high since 2002. That's more than in 14 years, 15 years from now, roughly, or 15 years ago. This is how high the dollar is. Now, believe it or not, I'm of the belief that the dollar is going to finish 2017 lower than where it goes into 2017. And we've got some great trades that we're playing in this, and there's going to be great opportunities in 2017 on the dollar. By the same token, if we look at the euro here is hit 2016 lows. All right, look at this. In fact, and let's go back to the daily here, and I'm going to just recalibrate my low here because we made new lows in the euro right here, just like this. And my forecast for the euro was to come down to about 102 area, from the zone of 102 down to about 101. And I had forecasted it sometime between December and first couple of quarters of next year. This was my forecast for the euro, and that's kind of where we're headed. And as you can see, just as back in December, the euro is up at 108, and it's given it all back up. So I'm not sure if we're going to get to that parity. I know Morgan Stanley and others are calling that, but you can see where I'm forecasting the euro, down around 102. So that is going to further put pressure on Draghi, because the lower the euro goes, the more it's going to introduce inflation across Europe. Look at Great Britain right now. The pound is about 15% off the $1.55 area before Brexit. Now the pound is down very low. It's introducing inflation across Europe. The Bank of England did not raise rates this last meeting a week or so ago, but I believe they're going to be forced to do it. And Draghi's going to be, it's going to bring in inflation in Great Britain, just like it's going to bring inflation across Europe. So I think 2017 is going to be some great opportunities. Right now I'm short the euro or the euro dollar, if you want to play the Forex side. But I believe the euro is going to finish 2017 higher than where it goes in, okay? And then by the same token, if we look at gold, even though gold finished up on Friday, my original stop point for gold was right in this area here, right around the 1200 area. You can see that zone there. We hung up there for about a week, and then we broke it. Once we broke it, I said 1130 is going to be the next stopping point, and sure enough, that's where we are. And I said, if we break 1130 and it does not hold, then the psychological barrier of 1100. The 2016 open price for gold is at 1061. All right, now we traded gold to the upside in the first quarter of this year, and we got out of it with some nice profits, and gold has given it all up starting in the middle of the summer when it hit the 2016 high of 1377, and it's just given it all up, right? It's been highly correlated to the bond market, because as interest rates go higher, bonds go lower, gold goes lower. Now, typically you may say, well, wait a minute, didn't the Feds raise their rates in December of 2015? In December of 2015, look at gold, it went up, right? Gold just shot up like that. So you're going, how is it different? Well, back in this area here, there was a fear of 4 rate hikes for 2016, if you will recall. because they had this out. But if you'll recall, the key was inflation was a bigger threat at that point in time. And gold, if anything, was an inflationary hedge. And when the markets fell going into February down to the February lows, there was a lot of existential events that drove up gold based on fear. Right now, this is not there is no fear in the markets. The markets just, hey, you know, VIX is very low. Everything's good, man. What, me worry? There is no bullish divergence in gold. That's why I believe it's still going to go a little bit lower. But I am also of the opinion here that gold is going to higher than where it entered the markets. Okay, so that's kind of where we're sitting here on that one. And then, of course, if we come over and we look at oil, oil was a really great trade that we made. Oil has just kind of confounded a lot of people. You can see here we had the 2016 high. It's pulling back a little bit, but I think we're going to find support here. We've been trading oil really nicely every month, and we're going to continue that into 2016. Agriculture is doing really well. We've got some longs in the meat market, and we're short orange juice. So we've got a lot of really good things going on here. Now, as I said earlier, one of the things, pay attention, guys. I'm going to send out a holiday offer in the next week or so. And this holiday offer, I'm now opening up to non-members. Folks, you can follow me with the trades that we're taking here in what we call our secret trader. I will send you a link to that probably next week, and you're going to get 50% off. It's very cheap. I'm doing it, and I do things really inexpensive here because I'm not looking to build my base. The money I make is just through trading, but you can follow along with me in the trades in our secret trader. So as a member, you get an even larger discount, but as a non-member, I'm going to give you a holiday offer that'll give you a really good discount on our secret trader. Now, next weekend is going to be Christmas weekend, and then the weekend after is going to be New Year's. Not really sure if I'm going to do a Christmas weekend. It may be very short and abbreviated, and then holiday New Year's. So if I don't come out with anything but something very short, then that's what it's going to be. But otherwise, guys, I hope you have a really good weekend. And if I don't talk to you before the end of the year, but I suspect I will, have a really good holiday season. I went a little bit longer than normal for this weekly roundup, but I wanted to just make sure I covered some of these key events and just kind of how I'm thinking going into Q1. And be on the lookout for that holiday offer, because I promise you I'm going to end it after the first couple of weeks in January, and you may not see it again for another year on this secret trader. And by the way, we're rounding out our secret trader for this year. We had a really fun time, made some good money for our members, and I think next year is going to be even more fun, more exciting. All right, everybody, have a really great weekend, and I will be in touch. Ciao, folks.